If you're going to be selling your property in 2026 and beyond, this is one conversation you cannot afford to ignore. Now, let me ask you a simple question. If you bought a property for 50 million and you sold that property for 100 million, how much tax do you think you should pay on the profit that you made? Now, before you answer this question, let me quickly give you a breakdown of the old tax law and the new tax law. Under the old tax law, when you sold a property and you made a profit, you are expected to pay 10% capital gain tax on this particular sale. So you made a profit of 50 million, you're expected to pay 5 million naira. Now, under the new tax law framework, your profit from selling a property may be taxed under your personal income bracket, which means that your tax is no longer just about the property. It is now about you, your income level, your tax bracket, your overall financial profile. Now, let's go back to the example that we gave. You buy a property for 50 million, you sell at 100 million. Now, instead of automatically paying 10% of this, you will now be taxed based on your total income for the year and based on your income bracket, which can automatically range up to 25%. Now, if your overall income for the year is 800,000 naira and below, you don't need to pay tax. But if you're earning from 2.2 million to 3 million, you're paying 15%. From 9 million to 13 million is 18%. 25 million naira above, you're looking at 23%, and about 50 million is above 25%. Now, in some cases, instead of paying 5 million, you could be looking at paying over 10 million naira tax, 100 million naira tax even, depending on the gain you made from selling a particular property. Now, with everything I've said, or with everything that you have currently heard, would you still sell your property the same way, or you would definitely plan differently? Now, first thing to planning is proper documentation. You need to clearly know what the property you bought is for. Is it for residential? Is it for commercial use? What you spent on improving the property. That means your expenses for making that property better, and what your actual profit is. Because your tax is based on your real gain, not just the selling price. Another thing you should consider is structure. Should I hold my property in my personal name or through a company name? Because how you hold your assets can influence how you will be taxed. Now, I'm not saying there is one perfect answer for everyone, but what is clear is this: you can no longer treat your property sale as just buying and selling. There is now a tax strategy layered to it, so do well to contact a tax expert to suit your preference need, because trust me, the gap between your profit and the net profit after tax is where smart investors are paying attention to. So now you have to be more intentional, you have to be more informed, and you have to be more strategic, because the days of ignoring tax implications in property transactions are slowly coming to an end. My name is Obi-Okuhon. If you enjoyed this YouTube video on what to expect when you sell your properties, do well to like, comment, share to your friends and families who might want to listen to this information. See you on the next video, and do not forget to subscribe. Thank you.